In order to be a great investor, you have to dare to be different, as I just explained. You have to be willing to do some things that are unpopular and by definition will look crazy.
Imagine a world where everyone is investing in the same direction, chasing the hottest trends, and now picture the opposite. Someone who dares to swim against the current, finding opportunities where others only see risk, and that's Howard Marks for you.
I think the goal in investing for professionals is to be above average. Investing is a funny business. It's really easy to be average. You just buy an index fund. It's really hard to be above average. But if you want to be above average,
a legendary investor whose contrarian approach has earned him immense respect and wealth in the industry. And now you must be wondering, how much does this guy profit if he invests in risky assets where everybody else is not investing? Well, guess what? Over 22 years, 19% a year. 19%. That is pretty good.
I think the goal in investing for professionals is to be above average. Investing is a funny business. It's really easy to be average. You just buy an index fund. It's really hard to be above average. But if you want to be above average, everything you do in the interest of being above average exposes you to the risk of being below average. You overweight certain stocks. That's potential error. You avoid certain stocks. That's potential error. You diversify abroad versus the U.S. That's potential error. You buy high beta stocks, low beta stocks, etc. You hold some cash. There's nothing you can do in the interest of being above average that does not expose you to the risk of being below average. So if you dare to be different, you have to be willing to be wrong.
And now you must be wondering, how much does this guy profit if he invests in risky assets where everybody else is not investing? Well, guess what? Over 22 years, 19% a year. 19%. That is pretty good. Give you an example. From mid-February 2020, COVID pandemic, right? The S&P 500, the whole S&P 500 fell by 1/3. And most investors were jumping ship, fleeing. Guess what? Howard Marks saw an opportunity. Boom, he gets into the S&P 500. And guess what? In 5 months, it increases by 51.1%. Just so you know, he is the co-founder of Oak Tree Capital Management, where his alternative investing approach has been working for over 28 years. All right, so what is his core investing philosophy? Here we go. There are 5. Principle number 1 is he believes that the best investment opportunities arise when others are fearful. Now, he talks about optimistic, but that's something else. Let's talk about fearful. A little bit like Warren Buffett, really. But the best example to demonstrate this is in 2008, right? He gets into high-yield bonds, but it took years before the economy recovered, and he generated huge returns. He has to wait years. I mean, it must be difficult to stay calm while everybody else is scared of risk. But guess what he says?
September 2008, Lehman Brothers goes bankrupt. Everybody thought the world was going to end and the financial system was going to melt down. We turned extremely aggressive, and we invested, I think $650 million a week on average for the next 15 weeks. That's $10 billion in a quarter. And obviously that was a good decision.
Every great investment is born in discomfort. I'm going to say that again. Every great investment is born in discomfort. Wow. Think about that for a second. Okay, the second principle of his contrarian approach is the markets are the riskiest when there is widespread belief there is no risk. And that was the case in 2007. What do we have? Booming house prices, excessive confidence in financial innovation, such as this new mortgage-backed securities everybody was selling, right? Didn't know what they were. General disregard for underlying credit risks. I mean, people were buying houses left, right, and center. And guess what happened? The housing market crashed in 2008. And this is exactly what Howard Marks is suspicious of. He calls it excessive optimism in an asset, assuming there is no risk. So he does not buy in this situation. Now, I find this really interesting because George Soros is totally different. He says, and you can watch one of our other videos where he says, when you see a bubble forming, jump in. So Howard Marks is the exact opposite. When he sees a bubble forming, it's time to get out. Over optimism, he's out. George Soros jumps in. Interesting, right? Principle number 3. How many of you have heard of this? Very well known. High risk, high returns. Or high risk, high rewards. Well, guess what? He believes low risk, high returns, right? Low risk, high returns. He says if one avoids the downside, then the upside will take care of itself. Now, that actually does make sense because it's all about risk management, something that I'm going to come on to in just a moment. So his company, Oaktree, is heavily invested in necessity products, energy and industrial stocks where the risk is low. People rely on these products and services. Demand is fairly constant regardless of economic conditions. So he advocates for risk management, often stating that you must control your risk and the upside will take care of itself. Principle number 4. Sometimes it's better to not act, to not do anything, right? He says, when there is nothing clever to do, mistakes lie in trying to do something clever. What does he mean by this? Well, when something happens in the market, avoid knee-jerk reaction, emotional decisions. Rather stick to well-considered strategies, and that will lead to long-term outcomes. Much, much better. Principle number 5, the cyclical nature of markets, right? He stresses the importance of understanding where are we in the market cycle and then make informed investment decisions based on where we are in the market. So what does this mean? All right, let's talk about how he enters. There are 3 stages of analyzing best buying opportunities, and guess what? They all have to do with the market cycle. So stage 1. There's fear among people. People are jumping ship. The asset is undervalued because nobody wants to know about it. Well, guess what? That is a good buying opportunity because he calls this bargain hunting. So let me give you an example. After the dot-com bubble bust in 2000, some of you might remember the tech stocks, right? When everybody wanted them, right? Any company with a dot-com people were buying. Valuations were through the roof, crazy, crazy, crazy. And boom, right? The whole thing busts. Well, guess what? Nobody wanted them. The tech stocks were heavily undervalued and nobody wanted to get into Amazon apart from people like him, right? Another example. Before the 2009 bankruptcy of GM, I mentioned it before, General Motors, Oaktree purchased General Motors' distressed debt at a significant discount. Why? Because nobody wanted to know. I mean, we're talking about 70% discounted. Well, guess what? When the company restructured, the value of these debts appreciated considerably. Wow. I mean, that must have been scary. Wow, wow, wow. All right, then there's stage number 2, right? After people are fearful, stage 2 is investors start to notice opportunities, yeah? But prices are still reasonably low, right? So as the financial system and economy begins to recover, prices start stabilizing, investors' hysteria starts to lessen. However, assets are still relatively undervalued compared to their, what he calls, intrinsic value. So I'll give you an example. In 2009, after the financial crisis, many investors began to recognize that banks and financial institutions were recovering. Stocks like JP Morgan, for example, began to rise. Oh gosh, I don't know what I would have done at that time, but he got in, and guess what? The rest is history. And then there's stage number 3, right? So you have the fear, then the recovery, and then there's stage 3, which is, of course, excessive optimism in the market. And guess what? Hence low potential for future gains. The risk-reward ratio is no longer there. Whereas down at the bottom, the risk, there's always risk, right? The risk is low, but the potential is incredibly high. At stage 2, it's kind of okay. Stage 3, So let me give you an example. The housing market, we all know, right? 2006, 2007, housing prices soared. Everyone believed that house prices would increase indefinitely. Really? This is what's called excessive optimism. Let's now talk about his criteria for taking profit. There's 3 ways that he exits. The first one is take profits when assets reach what he considers to be their intrinsic value. Now, I've mentioned this before. Intrinsic value is based on the asset's fundamentals, such as earnings, such as cash flow, and other things like that. That is what it's supposed, apparently, to be valued at. And when the company reaches its intrinsic value or goes past its intrinsic value, that's when it's time to lock in those profits. The second way that he might get out is he takes into consideration the risk-reward ratio. So for example, at stage number 3 that I just mentioned just now, you still have risk, but you don't really have as much upside reward as you did on stage 1. You still have risk, but you have huge reward, right? Here it might be less. Here it's like this. You have all this risk, but the reward is really, really small, right? At that stage, he probably will start getting out. And the final third situation when Marx exits the market is if his investment thesis changes due to new information that he has, or a shift in the company or the market's fundamentals. I mean, that's just like Warren Buffett. He always says, if anything changes in the market, any new news, get out. All right, so Mark obviously agrees with him. If the original rationale for the investment that you made no longer holds, Mark chooses to exit his position. So, conclusion, let's get some key investing lessons. Focus on when investors are fearful, right? Get in. Too optimistic? Get out. Risk management. Marx follows the market's cyclical nature in order to mitigate risk. Get in near the bottom of the cycle, even in the middle, but not at the top, right? That's when he'll get out. Leave that to others. And the example we gave was the auto industry, very, very cyclical, and he knows that, right? Some people don't know that, right? He knows that, and therefore challenges that General Motors had, he knows are temporary, so he got in. So other people are thinking, my goodness, I can't believe you did that, but he knows something. He knows it's a cyclical industry. So, shall we have a look at some of his portfolio maybe? I've got a printout here. Out of the 30-odd companies that he's invested in, the top 5 make up 51% of his portfolio. So, and what the other thing that's interesting actually is that it's energy. Energy, 3 of them are energy, right? So for example, at the moment he's invested in something called TORM, T-O-R-M. This is energy, oil and gas, okay? This is operates a fleet of tankers transporting refined oil, gasoline, jet fuel, kerosene fuel. His second position is in Chesapeake Energy, yeah, which is the exploration and acquisition and development of natural oil and gas. Why? Because his rationale is, well, people will always need gas, they will always need oil, etc., and so forth, right? I mean, his 4th largest position is the same thing, oil and gas exploration, in something called Sitio Royalties, which is slightly different because they actually manage and acquire mineral and royalty interests, but again, in oil. So it's interesting, different ways of playing it. And then he has a consumer cyclical. So again, this cyclical thing, right? He understands cycles. And I guess he must think we must be in either stage 1 or stage 2, not in stage 3. Why? Because guess what? This is in Garrett Motion, which has to do with automotive and commercial vehicles. So he obviously specializes in that as well. And then he has a finance corporation. This is so interesting because these are things that I wouldn't necessarily invest in. But hey, 19% over, what do we say, 22, 28 years? I'm telling you, that is look, you can, listen, 19% on your own personal portfolio, no problem. Literally, no problem. But 19% investing other people's money as an asset manager, when you have large amounts of money, that is some going. That is some going, I tell you. So this runway growth, what does it do? It provides loans to high growth companies in technology, life science, and other innovative sectors. Do you know what I love about this series? We've done it on several people. Things like people like Warren Buffett, is it Lynch, Peter Lynch? We've done Soros, we've done Jim Rogers. And look at all the different ways of making